Hey, good morning, everybody. Tamara. Today is Thursday, November 9th, 2023. I, of course, with Originator Success here at the Daily Rate Lock Conversation, where we do the mortgage rate update, the only place on the web where you guys can be part of the conversation. Remember, you can join me live each and every day, 9:30 a.m. Eastern time, like my man Cash Knees, who was here this morning. If you're here, say good morning. If you're watching on the replay, do me a favor, give me a hashtag replay in the comments. Let me know that you were here. Let Facebook know that you were here. Let YouTube know that you were here. Don't forget to smash that like button, tag an LO friend, share us in a group. If you're watching on Facebook, go ahead and subscribe. Make sure you click that thumbs up, and I think they have a notification thing so that you'll be notified when we're doing this. So you can always go back and watch the replay. Remember, you can sign up for our written email lock advice to your inbox each and every day, www.ratelockadvice.com. Or if you're watching on the computer, take your phone, scan this cool QR code, sign up for the written lock advice. You can also sign up for our text alerts. They're $7 a month. You can't beat them. You should join them. www.ratetextalerts.com. We send out a morning and afternoon alert, as well as alerts through the day when reprice risk is the highest. And then last but not least, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media. We are awesome at that. It's what we do. It's what we love to do. It's what my team is trained to do. They are awesome sauce at that. Let's go ahead and say hi to the live folks here this morning. We've got Lisa Bollinger here. Good morning. We've got Scott Menser. Good morning. Who else is here? Say good morning. Let me know that you're here. We got Darcy. We've got Tom Deadmore, Monica Dinkins. Good morning, all. Mallory Fotiadis. Hello. Great to see you. All right, let's go ahead and jump in. Allison Foy. Hey. All right. Now we're going to jump in for real. A quick recap on the bonds yesterday. Take a look. I have this down here in the bottom right corner of the screen. You know what? Let me zoom in on this. I might have to reload the page. Yep, I got to reload the page. Give me a minute to reload the page. I want to show you yesterday bonds improved through the day. Very, very, very few reprices better, though. Generally, only the most aggressive lenders were repricing better yesterday. You could see it here. We started the day down a little bit, and then we got a nice bump up. That's the same thing that happened here on Tuesday. Monday was the only day that was really kind of flat. Tuesday, we got a little bit of an improvement. We lost ground heading into the next day, improved again. This morning, same pattern, lost ground heading into the day in overnight trading, but we've seen a nice recovery. And this puts us really basically in the same spot as when pricing came out yesterday. Pricing comes out around 10 a.m.-ish. We'll say between, this high point of 99 up to 11, also around 99, a little bit lower here. You'll see that we actually are a little bit better than that right now. And if this holds as pricing starts to come out, we'll actually see slightly better pricing than yesterday. Not a lot, but a little bit. So we are seeing a lot of improvement here, but only the most aggressive lenders repriced better yesterday. Very few. Let me know in the comments, Jennifer Zakaris, Ron Siegel, if you guys saw a reprice better. And of course, everybody else, y'all let me know too. Let me know in the comments if you guys saw a reprice better yesterday. Today, rate sheets are going to be very similar to yesterday. Again, based on what we're seeing right now, we've got about over the next hour or so is when most lenders set pricing. Could see a little bit better rates, a little bit worse rates. I wrote inside of the daily email that I send out every day. I also wrote out this morning that many of you, that there's a lot of discrepancy amongst lenders right now. And this is not a channel conversation. This is not a brokers versus retail conversation. Because again, I originated for over a decade. I did it for big companies like Countrywide and GMAC Mortgage. I did it for correspondent lenders like Globe Mortgage. I did it for straight up brokers like Jacob D Mortgage. I did all of it, okay? So I've been there. I know this industry inside and out. There are some big producers that work at retail lenders that get better pricing than brokers. You guys may not always agree with that on the broker side, but I've seen it and I lived it and I had it. I could pick up the phone and call the credit policy manager at GMAC Mortgage and I could get a loan done just by saying this loan needs to get done. Because we used to portfolio loans. They were called 700 files. We used to portfolio loans that needed to be done that couldn't be sold because they didn't meet guidelines. But because I was a high producer, if I said this loan needs to get done, it got done. Generally, that was done for the GMAC family, for like GM dealer principals, the folks that owned car dealerships or were high up executives in car dealerships, things like that. So anyway, my point being, a lot of discrepancy amongst rate sheets right now. If we use Mortgage News Daily as a reference point, you guys know I do this on the video all the time. This is really what I'm referencing, just as a reference point because of the consistency. I like the way that Matt Graham uses it. basically when he does, he's pulling from multiple rate sheets, and you can use a pricing engine. You're getting an average. You could see here though that we got as far down as 7 3/8, and we're very close to that. But yet I see some folks that are like, oh, Hammer, we've already lost half of those gains. And it's like, nah, you really shouldn't have. When you look at what happened in the bond market, we saw the mortgage-backed securities, they really shot up high, and we ended the week at 99.14. And what are we at right now? 99.05. We're only 10 basis points off the best levels that we were at on Friday, which means you really should not have seen a lot of retracement. What that means is that lenders are making decisions on how they want to manage their pipeline, manage their margins, and things like that. And that's lender by lender. And I'm not throwing shade on anybody. They're all trying to weather the storm, and they're all making decisions. I didn't really talk about it before, but some lenders never really put all of the improvements onto rate sheets because they didn't want to deal with the float down policies. I've heard quite a few different LOs that said, well, we haven't triggered our float down policy. Well, that was on purpose, because when I look over here at what's going on in the bond market, it triggered the float down policies. You're talking a jump of a minimum of a 0.5 point in rate based on what we saw over here on the bond market. So, but not every lender is going to see that. And you can't get mad about that, y'all. It's just the environment that we're in. It's in the markets that we're in. All right. So keep that going on, and you will see that as well. So anyway, when we look at this pattern, mortgage bonds have really kind of fallen flat here. They're running flat. We've pushed up. Remember, we were down here. We jumped up. Now we're just in this zone. You could say that we're between the 50, the red line here, the 50, and the 100, the green line, day moving average. And that's very much the case. Now, I'm going to go ahead and adjust my my lock advice in a minute. Let me see. I'm going to say cautiously float every except less than 15 days and risk averse. All right, so I'm going to throw this up on the screen for y'all. And my advice, I'm moving, now that we have seen a few days in a row where we've seen mortgage bonds hold these gains, that's a big deal, because our big risk coming off of last week's improvements, we saw epic improvements. We saw huge swings. I mean, we ended the week before, the Friday before here, we were at 97.08 for the 6.0 coupon. All right. Friday, October 27th was at 97. And then a week later, Friday, November 3rd was at 99.14. So we were at 97.08 to 99.14. That's over 200 basis points in 1 week. That is a huge, huge swing. What can sometimes happen, and often is the case, is that after we see a big jump, we would normally expect to see things drop. And in fact, let me go ahead and pop. I'm going to take a screen capture of this so I could draw some arrows for you real quick. So looking here at this going on, normally after we peaked right here, you see this line right here? That's where we peaked on Friday. Normally what we would have seen happen is, and we started to see it on Monday, it started to come down, right? So on Monday, we were like, okay. And then what we would, expect to see from there is probably something like this, and give back at least half those gains. And again, we're looking at the fancy charts, but this would have been on your rate sheet. This would have been what it would look like if you were giving back half those gains. We would be 100 basis points lower. All right. But instead, this is where we're at right here. You can see that we are spending time in this channel. And what I'm actually going to do is let me just take this and, kind of show you, as of right now, we are within this range. This is the active range that we are, currently working with in here. And as long as we stay within this range like this, oops, no, I don't want that one. Hold on. Too many drawings here. All right, here we go. As long as we see mortgage bonds staying within this range, there is a lot less risk to floating. Now that we're on Thursday, y'all, and we're still seeing it. Yes, mortgage-backed securities are down a little bit on the day, but we've seen the similar behavior that we've seen before. We ended yesterday 99.27, a lot of gains. Very few reprices better, though. We talked about that. This morning in overnight trading, we lost a lot of ground there. All right. However, we were all the way down, low point 98.86. and we've recovered to 99, let's call it '06. We've recovered 20 basis points. So we were down 40 basis points early, but yet we've recovered. And we've seen that same pattern. If we go ahead and look at the 5-day, we've seen this pattern before. And this is what, we've seen it happen. We had a bit of it seems bigger loss than normal because yesterday was a bit of an afternoon gain right at the end. So we wouldn't have seen that much of a loss, but we're seeing this recovery. What does this show us? Again, we're seeing that if we look at Fed futures, expectation of a Fed rate hike in December staying below 10%. Market and market sentiment very much in the situation in the corner that rates are going to stay where they're at. Markets are pricing in that the Fed is done raising rates. I'm looking at the 6.0 coupon right now, Mike, but it doesn't matter. You can do the 6.5. I think it was 170 basis points on the 6.5. They all moved, So we went from following the 6.5 coupon to the 6.0 coupon. I'm definitely listen. We've got next week. We have inflation data that's going to hit on Tuesday. And that is the CPI consumer inflation. Wednesday, we get the producer price inflation. We're going to get retail sales. Loans closing near term. If, again, I did that whole thing talking about lenders that have not passed along the gains. If you've got healthy rate sheets right now, if you're seeing something similar to what you're seeing as far as base rates before loan level price adjustments to what we're looking at here on Mortgage News Daily, then I would suggest for loans closing near term to lock those, because if the data disappoints next week, we don't have time to recover. That's the bottom line. If the data disappoints, we don't have time to recover. However, we hopefully have seen rates crest. We've seen the worst behind us. I thought we did that once before a month ago, remember? And I said it was a false peak, that it's like a false summit. If you're a mountain climber, you climb up, you think you're getting to the top, you get there and you realize there's actually another part of the mountain that you couldn't see. That's what happened with rates. We saw that happen over here. When we look at what happened, it looked like we were going to, that we were recovering, looked like boom, that we were picking up. And then all of a sudden, bang, we lost that other one. Looked like right here, back at the beginning of October, we were in a great situation. And instead we, spiraled and saw our worst levels over here. And let me get this out of the way so you guys can see it. All right, so our worst levels down here, this was back in October 19th. And then we started to recover, and then boom, this big recovery was because, and I warned you, we were going to see a wave. We were going to see sentiment, but I didn't know which direction. I don't have a crystal ball. Last week, I said we were either going to get really good or really bad. We had a position where we were either going to see rates continue to go up higher or see them fall back. We saw that 10-year treasury yield hit 5%. I said if we were convincingly above that 5% mark for that 10-year treasury yield, we're going to go up to 5.25, maybe even 5.5. Thankfully, although we touched on that 5%, we flirted with it really. You can see it right here. It wasn't convincing that it broke through that level. Because of that, now we've seen a big dip in this 10-year treasury. look here, by the way, we're broke below this 50-day moving average. This is a big deal. This is a resistance level stopping further improvement. We were at 4.576 or 4.57 when it was at 4.56. It's moved up to 4.57. And yesterday we closed at 4.49, which is 4.5, right? Today we're 4.54, but we'll see which direction this goes through the day. If we see improvement, if we stay below that 50-day moving average for the 10-year treasury yield, this is a good sign. So because of that, again, I'm now moving towards cautiously floating. We have enough time under our belt the last few days to feel more comfortable that we're not just going to have the rug swept out from under us. What next week's inflation data brings. We want to see how markets react to it with when they think the Fed is going to start cutting. Again, right now we're watching these March, May, June dates. In March, markets expect a 67% expectation will still be at 5.25. That's where the Fed funds rate is right now. By May, they're starting to look that it will be at 5. This was higher a few days ago. This was higher. Now it's really kind of in June. That's when we see the big jump where they're like, okay, now we think we're going to get the first rate cut. That's what Fed futures, that's what markets are pricing in right now, that we're going to see the first rate cut in June. If we start to see softening economic data, remember, we don't need to see inflation go lower and lower and lower. We need to just see it continue to stay low and go a little bit lower each time. Nobody is expecting inflation to drop between now and the next 3 months all the way back down to 2% or 1%, right? But if it stays at that core number, they're watching that core number. If it stays around the threes, that's going to be okay. If we get a surprise reading where it cools more than expected, then it's going to open the door for rates to improve a little bit further. Also, we're going to be looking for signs soon of what Ron Siegel has talked about a lot, which is that margin between the 10-year treasury yield and mortgage bonds. A little bit more of a complex topic. We'll hit that one another day. I wanted to ask you guys real quick, by the way, I wanted to go over some headlines. So let's talk about this. There is a headline here at Bloomberg that I saw this morning. It's going to take me a minute to find it because hold on, here it is. U.S. veterans got a mortgage break. Now they're losing their homes. A COVID-era program gave borrowers a year without mortgage payments. Do you remember we talked about this? How the media, these same scumbags, were promoting it like pause your mortgage. And it was forbearance plans. It was for people who couldn't pay their bills, but instead it was being promoted as pause your mortgage. I mean, why not? Well, now it's biting people in the ass that for these forbearance plans, that they have to come up with the missing payments or different things. I haven't had the chance to read this article. I encourage all of you to. You don't need to pay for Bloomberg. You can use an incognito window and it'll give you 3 free articles and you can read the article. Right. So I'm going to post the link to this article here in the comments. I'd like you guys to see on this. I put this on Facebook asking some of my, some folks for some feedback on this. I feel like I've seen these authors like this Polly Masens. She has gone after UWM. She went after Change, and I don't like Change Mortgage, but she really likes to go after the industry. I haven't done any research on Ann Choi. I feel like this is a very biased article. I read through it. Again, I just feel like people that don't know the industry, they spin it. The first one talks about UWM, and I have the utmost respect for UWM. I really do. I think that Matt Ishbia is a stand-up guy. And I think that their company is a stand-up company. Whereas like Wells Fargo, let's face it, Wells Fargo, they've shown to be scumbags in the past. I find this to be, whatever here. Ron said, our jerk in California, Gavin Newsom, went on TV telling people they did not need to pay the mortgage. At the time, we were telling folks to be careful. Yeah, I definitely believe that that's the case here. So I would like to know more, you guys give me some feedback in the comments. Let me know what you guys think about this. Do you feel like, they make it sound like the lenders want to foreclose on the houses. They don't even realize lenders don't want homes. They don't want to foreclose, but when they're servicing the loan, this one talks about how she had, recently divorced. And so there's title issues here for doing a modification and all these different things. They really spin it, the part that I've read so far, and it just burns me up. It pisses me off. I just feel like we're painted to be an industry. As far as some other stuff here, this is also another interesting article that you may want to take a peek at. It's a little over, like high level, if you will, but dark matter bond metric mesmerizes Wall Street and Washington. This is actually very interesting. And then another one that's an older one is understanding what term premiums are when it comes to bonds. Again, these are things that don't worry about it. I'll digest this stuff so I can give you guys, some tidbits on it. But basically, this just talks about how the economic engine is running right now, what bonds are doing, that kind of a thing. So anyway, I've been chattering a long time here. Scott said, I thought the money was added to the back of the loan on the COVID pause payments. It did not have to be that way, Scott. A lot of lenders are doing that, a lot of servicers, but it's complicated. When you can't just like tag it on there because you have a loan documents that have already been set up. So it's got to be modified. And when they're doing a modification, well, now she's divorced. The ex-husband is, he's not signing the loan modification and he's not taking on the debt. So now so like there's complications to all this, and they just don't. They pretend like lenders are just like, oh well, we don't want to deal with that. We're going to steal your house, and that's what aggravates me. They don't recognize that when this financial instrument is executed with two parties on title and they get divorced, that now you can't just modify that. Like, and she ignored that, like I love in this article, it talks UWM has a documented record. It says that we tried to call her 36 times. I love this, right? She was pissed, this is embarrassing, blah, blah, blah. Well, at least they put this in the article. The company said it had attempted telephone contact with her 35 times last year and 43 times this year. She's a real estate agent, so I don't have a hard time believing that one. There's, again, two sides to that story. This is a very different story. It's all being set up there. So anyway, all right, y'all, thank you for joining me. I will see you guys tomorrow. If you are on YouTube, please make sure that you go ahead, subscribe, thumbs up, hit that notification thing. We're going to really push to get this channel going. I'm going to be putting more content besides just the daily rate lock advice on there. So we'll be putting some stuff on here to help you with your business. Also on Facebook, same thing. So, all right, my friends, I'll see you guys tomorrow. Take care. Make it a fantastic one. Bye-bye.